Good morning and happy Friday. A couple of very quick points. Just want to share with you what's happening in volatility space, price space, volume space, why I believe this market is setting itself up for a bit of a quick downturn. It might be short-lived. It's always going to be one of those kinds of ebb and flows environment as we move into that quad four kind of probability. And remember, all we're attempting to do is risk manage probabilities that not only are signaling via the economic sine curve, but also what's being signaled on a technical basis with price volume volatility and the calculations that go into that. So I'm going to share my screens with you real quick, show you some of the volatility items that we're seeing and what we're doing with it. We're also just getting more confirmation in terms of the probabilities of that quad four kind of a deflationary cycle. And again, these things take time to develop, so it's not like a one-off, 1 day, 1 week kind of a scenario. It's a building process. And so what we've been doing over the past several days is building our treasury positions because interest rates have been tapping the top portion of the mathematical range on the 10-year treasury for the last several days. And that's normal. One of the things that we need to remember is that the last quad four call we had was in January of 2020. So for those of you who we've been blessed to work for a long time and we're here in January, you remember what we were doing. We were lowering our gross equity exposure at the time. As January worked itself through and we got into February, we started to lower our investment grade bond exposure. And then ultimately on February the 24th, when markets across the spectrum started to break, we liquidated all those assets. And by February 24th, we were completely out of our net long exposure of U.S. equities. And of course, on February 24th, we were completely out of investment grade bonds. And then as that quad four development started to continue to grow, we started making some of those treasury trades that you're seeing right now. So we may be a little bit early in the quad four call. We were a little bit early in terms of dealing with it in January, but I'd rather be early than late in something like this. Am I expecting the market to crash? No, I'm not at a point where I expect the market to crash. However, we're in a regime of volatility where U.S. equities become very, very, very choppy. And so that chop creates a much more tradable environment versus a buy and hold environment like what you would get with volatility down in the teens. And we're not seeing that. So let me share my screens with you very, very quickly, and we'll move on. So this is just a quick picture of a real-time element of volatility for U.S. equities. This is VIX, as you're well aware. VIX represents predominantly the S&P 500. This morning's mathematical range of probable movement was 2505 to 2996. And basically the way to look at this is that when VIX reaches the low end of the mathematical range, you sell equities and or short if your risk exposure or risk component of your portfolio allows us to build a portion of the portfolio that would actually go up when U.S. equities go down. So at 2505, what we're doing is increasing our net short exposure to the U.S. equity market by way of and represented through an inverse exchange traded fund. If in the event we see VIX ultimately turn around, which I think is a high probability event, if we get to that 2505 range, I think it's a very high probability event that we then shoot back up to here. As VIX shoots up, the U.S. equity market prices will come down. And so that increases the value of our short positions. As those short positions increase in value, we start to take some of that profit off the table. So this is a picture of VIX. The next one I want to share with you is a picture of NASDAQ volatility. NASDAQ volatility had a range of probable movement today of 34.43 to 38. You can see we're well below that at 32.64. So there are a number of rules that I use whenever I'm either reducing my net gross exposure to the U.S. equity market or I'm increasing my net short exposure. And those rules basically are a fundamental process of working the math of the market, the price volume volatility calculations that I talk about so much. and with volatility being the driving element behind that. And so basically, if I'm seeing a lower high in that calculation that identifies the movement of the equity market, that's a major plus. If we look in the options market and we're seeing something called an implied volatility discount, that means the market's getting very complacent. And we're seeing complacency across the spectrum right now, not only in the Russell 2000, but the S&P 500 and the NASDAQ, that is, specifically the NASDAQ 100. And so that last screen that I just showed you with VXN down below 3443, what that tells me is that in addition to the complacency, in addition to the lower highs, in addition to lowering volume on up days in price, the market's complacency is getting to a point where we would not be surprised at seeing that correction. And so therefore, what do? We start working into those short positions, working down the gross long exposure to stay away from the bump that we think could very quickly and easily happen in U.S. equity markets. So let me share my screens again. These little blue squiggly lines that you see there, all that is a representation of the mathematical formula that goes into identifying price, volume, and volatility. And so as this squeezes, what that does is that creates the probability that the movement of the price goes up. Now, again, this is volatility. So movement up in price brings with it a decline in price. You can see the last time we had a nice swoon up at the end of August. And we obviously remember what happened to the NASDAQ in terms of price at that time. As this widens, now this is the price of the NASDAQ, as this widens, what that does is it increases the probability of a net reversal. So those are the things that we're looking at. Price, volume, volatility. We're looking for price to be reaching a high level comparative to the mathematical model. We're looking for volatility to reach a low level of the mathematical model. We're looking for complacency in implied volatility discounts. We're looking at lower volume levels in terms of the overall mechanism of the NASDAQ 100. This is represented in the Qs or QQQ, so you can see the volume coming down here. Same thing is true if we look at the Russell 2000. It appears we could see a bit of a reversal there today as its volatility quotient gets down below the level that we expected. We expected a low of about 31 on volatility. So all that to be said is that if you're listening to this video and you say, oh my God, my head hurts from all the math and I don't understand everything that you're talking about, no problem. My hope is that during these videos, you walk away with not necessarily an understanding of calculus or how it works or why it applies to a market, but simply to walk away from these videos knowing that we have a very strong process, not founded on narratives or noise that's going on, because there's a lot of that. There's a lot of narratives. The narratives right now are revolving around more stimulus in the market, what the Fed can and can't do, what Congress will or won't do, the presidential election. All those are narratives and noise that honestly have absolutely nothing to do with the day-to-day movement of markets. And it certainly doesn't have anything to do with risk management in terms of what we're attempting to do for our portfolios, my family's portfolio included, because I do the exact same thing as I do for each of you. So what I'm hoping you walk away with is a full understanding and knowledge that we have a process founded on black and white principles of mathematics, that we have an ironclad discipline that has nothing to do with or are impacted by the emotions that can be brought into markets because of the narratives and noise. That's my hope. So if you don't understand everything that I'm talking about, that's okay. Feel free to ask me any question that you might have. Shoot me an email, send me a comment, whatever it might be. Again, my hope is that you can just recognize and understand what we're attempting to do. That we believe, moving more heavily into a quad 4 environment in terms of the economic sine curve, which brings with it deflation. The only time the US dollar goes up is during a deflationary event. So we're increasing our exposure to the US dollar as represented by symbol UUP in the exchange traded fund market. We're increasing our net exposure to treasuries across the curve, short term, 1 to 3 years, 5 to 7, 7 to 10, 20 plus, and then extended duration on top of that. During that process, we're continuing to maintain a cash position because volatility is at the low end of the range, because prices are at the top end of the range, because there's implied volatility discounts being worked into the options market. All this stuff is giving us much, much more confidence to increase any net short positions, presuming your portfolio allows that risk exposure. And so that's what you're seeing happening in your portfolio right now. If the market corrects and turns around, we'll unwind the shorts, take a profit, and just continue to move on and look for those quad 4 equity opportunities that exist in real estate, REITs, consumer staples, things of that nature, the things that work in a deflationary cycle. And there are a number of them. So if we get to VIX 30, you'll see me starting to buy a bunch of U.S. equities in terms of exchange-traded funds that represent those sectors to give us some exposure and growth opportunities within this cycle. If VIX breaks above 30 and stays there, that's not an environment to have any U.S. equities on, and clearly I would communicate that and let you know what we're doing. So anyway, thank you again for the opportunity to work for you. I am blessed to be on Measure to be able to do this. I'm hopeful that these videos are helpful for you in understanding our process, but as I said, I don't recognize or I don't expect you to understand everything that I'm saying. I'm just hopeful that you walk away from these videos knowing that we have a process founded on strong fundamentals of mathematics with no noise, no emotion, and no narratives that are changing our perspective. We're going to follow the data. We're going to do what the math says, and we're going to keep moving forward, risk managing each and every position that we put on. So with that, thank you so much for your time. Thank you for the opportunity to work for you. I hope you have an amazing weekend. Enjoy the weather. It looks incredible. God bless, and have a beautiful day.